Thanks for tuning in to this week's audiocast. We call this audiocast Cutting Through the Noise, and I'm Tony Welch, Chief Investment Officer at Signature FD. So to kick off from last week, markets were certainly met with a burst of volatility, especially early in the week. And we're going to spend a little time talking about the trend evidence in general and where we are from a sentiment and seasonality perspective. And then we'll also take a look at the earnings season, which will soon come to an unofficial close here when Walmart reports later this week. And we'll run through some of the macro data from last week and discuss what we're watching in the week ahead. So starting with what's happening from a trend perspective. So last week, the S&P 500 was essentially unchanged. Now, you might not have guessed that, given that there was a pretty sizable drop on Monday. And much of that was driven by the unwind of this so-called carry trade. In this case, investors had borrowed at Japanese interest rates to invest in higher returning assets. Now, the Bank of Japan hiked interest rates while the markets were beginning to project a pretty aggressive easing cycle from the US central bank. So the policies were diverging from each other. And what happened was that sent the yen higher and resulted in a needed liquidation of some of those leverage trades. We saw a big spike in volatility, notably in the VIX index, which measures option market volatility. Now, by the end of the week, much of that volatility had subsided. But we don't want to ignore that spike in volatility entirely. Historically, when the VIX spikes, the following short-term environment that's continued to be one of higher volatility. And this volatility spike occurred in August. What's significant about that is August has historically been a tough month for stocks. And September is actually the only month that stocks have averaged a loss. So our expectation here is that from a trend perspective, there's likely going to be more big one-day moves, both to the downside and the upside, in the next 7 or 8 weeks ahead. But the good news is that the turn to October has really tended to be a positive development. So if some additional volatility can shake out really a lot of the optimistic sentiment that we've been seeing, without doing so much damage to longer term trends, that could set up a solid year-end rally. Now, turning to corporate earnings, with nearly the entirety of the S&P 500 reporting, it looks like growth was a bit more than 10% in the second quarter. Now, that's solid, and analysts project growth will continue to post positive rates in the upcoming 2 quarters. Now, a lot of that's going to hinge on the trajectory here of the US economy. Right now, it looks to us as if growth is easing, but not close to a recession yet. Interestingly, I looked up the SOM rule on Google Trends this morning to see how popular the recession narrative is getting. Now, searches for this term, SOM rule, spiked last week. And the SOM rule is named for economist Claudia Somm. And it states that the economy is likely in a recession when the unemployment rate is 0.5% higher than its low of the past 12 months. And we essentially achieved that unfortunate level in the last employment report. While we're careful to say this time is different, we do take some comfort in the guts of the labor market reports lately. Now, the economy is still producing jobs, and importantly, construction employment that just reached a new cycle high. We would expect to see job contraction, especially in cyclical areas like construction, if the economy was in a recession right now. Additionally, the unemployment claims data that we got last week, that was pretty benign. Now, the other interesting data from last week was mortgage rates. Rates have been falling closer to 6.5 on a 30-year mortgage and 6 on a 15-year. Not surprisingly, refi activity really spiked last week, but we haven't yet seen new applications pick up meaningfully. Housing affordability, it really remains an issue, and existing homeowners do not have much incentive to give up their 3% loans today. I continue to think that a 30-year rate with a 5 handle on it, that would be psychologically important. Now, we're not there yet, but we're getting closer. As we turn to this week, the biggest data is going to come at us in the form of inflation. We get producer prices on Tuesday, consumer prices on Wednesday, and import prices on Thursday. We also get retail sales data on Thursday and consumer confidence on Friday. Now, last week was pretty quiet on the data front, but this week is relatively jam-packed. To wrap everything up, economic growth looks to be easing, but not to recessionary levels yet. Corporate profits are trending higher, and the market is in a tough spot on the calendar, and volatility does tend to beget more volatility. Now, the good news on that is once we get through September, the calendar becomes much more friendly from a historic perspective. Now, join us next week as we work through what the inflation reports mean and especially how they could impact Fed policy here in September. As always, thank you for tuning in.